According to Raymond James Chief Investment Officer Larry Adam, despite uncertainties surrounding inflation, interest rates, the political landscape, and a new disruptor in the artificial intelligence race, domestic equities ended the first month of 2025 broadly positive, reflecting a continuing optimism for the U.S. economy. AI-themed stocks, which have pulled headline indices upward for the past 2 years, were shaken by a new entrant into the space, China's DeepSeek, which claims to be more efficient in various ways, especially power consumption, than key competitor OpenAI's ChatGPT. DeepSeek's unveiling also took a toll on energy and utility sector stocks, which were benefiting from an expectation that growth in power-hungry AI would spike electricity demand. With mega-cap tech valuations stretched, those companies were vulnerable to a pullback. While the NASDAQ took most of the hit, the performance of the equal weight S&P 500 versus the capitalization-weighted index shows signs of the market broadening beyond tech that we hope will continue. Amid the many changes that greeted the new year, including the inauguration of President Donald Trump, the Federal Reserve held interest rates constant as expected, as the Federal Open Market Committee awaits clear signs that inflation will continue to slide toward target levels and insight into the federal government's trade and fiscal priorities. The equity market is off to a solid start this year, with the S&P 500 up around 3.3% in January. Following the mantra, as goes January, so goes the market. This bodes well for the rest of the year. Historically, since 1934, the S&P 500 has risen 10.5% through year-end after a positive January, compared to just 2.5% after a negative month. This aligns with our positive equity outlook, as a supportive macro backdrop and healthy earnings growth should drive the equity market higher over the next 12 months. December saw higher than expected employment growth, but overall contraction. The rate of unemployment decreased modestly as total employment increased strongly. Although we expect the total job creation number for 2024 to be shaved downward once the benchmarks come in later this year, growth was still significant, consistent with the amount of uncertainty in the market regarding inflation, interest rates, fiscal and trade policy, and the potential disruption to domestic AI dominance from China. Market volatility increased throughout December and January. A period of anxiety can be beneficial, however, as a market free of pessimism can unbalance risk and reward expectations, pushing investors toward untenable positions. The initial days of the second Trump administration revealed several important things to watch for. The flurry of executive orders included actions ranging from symbolic gestures to unilateral policy decisions. Time will tell how many make it past legal challenges and congressional authority. The executive order on trade policy lays out a roadmap including tariffs ranging from universal to sector specific, and ramps up restrictions on the flow of tech to China. The beginning of the year has started off strong, but time will tell whether that trend will hold. Uncertainty remains a familiar theme moving forward as inflation remains sticky and the policy decisions of a new administration begin to take shape. Expect volatility and emotional reactions in the markets in the coming months, but with a positive overall tone throughout the year. And that's all for this month's market recap. If you or your family have any questions or would like to speak to my team and I to get your financial roadmap laid out, please don't hesitate to reach out anytime. And as always, thank you for watching and have a blessed day.